You invest money the way you were taught. A little into your 401k every month. Maybe an index fund. Maybe a savings account that you tell yourself you will move into something better eventually. Maybe a stock or two that a coworker mentioned. You're doing what you were told. Being responsible. Being adult. Being the version of yourself that future you will thank. The billionaire invests differently. Not just more. Differently. The instruments available to you and the instruments available to a billionaire are not the same instruments. The strategies open to you and the strategies open to a billionaire are not the same strategies. The tax treatment of your investments and the tax treatment of their investments are not the same tax treatment. You're playing the same game with a different rulebook, and nobody gave you their rulebook. This is not about envy. This is not about outrage. This is about understanding a system clearly enough to use every part of it that is available to you, and understanding why the parts that are not available to you are not available. Knowledge is not the same as access, but knowledge is the beginning of access. This is how billionaires actually invest their money. Every method, every instrument, every strategy, from the ones available to anyone to the ones available to almost nobody. All of it. Here, public equities. The foundation everyone shares. You own stocks. So does the billionaire. This is the one area where the instruments are genuinely the same. A share of Apple is a share of Apple whether you own one or Warren Buffett owns $10 billion worth. The difference is not the instrument. The difference is the approach. You buy stocks. The billionaire buys businesses. The distinction sounds like semantics. It is not semantics. When you buy a stock, you are typically responding to a signal, a tip, a trend, a headline, a feeling that the company is going somewhere. You're making a short to medium-term judgment about price direction. When the billionaire buys a business, they are making a long-term judgment about intrinsic value, not what the stock will do next quarter, what the business will earn over the next decade. Warren Buffett has held Coca-Cola shares since 1988, not because Coca-Cola's stock price has gone up every year, because Coca-Cola sells 2 billion servings of its products every day in over 200 countries, and that business will almost certainly continue doing so for the foreseeable future. The billionaire does not buy what is going up. The billionaire buys what is worth more than the market currently believes it is worth, and then waits for the market to figure that out. The patience is the strategy. Your 401k does this imperfectly but genuinely through index funds. The index fund does not pick winners. It owns everything. The winners lift the whole portfolio. The losers are gradually replaced by stronger companies. The compounding happens quietly over decades. This is the one investment method that is genuinely democratized, available to everyone, proven over a century of data, and almost universally underused because it is too boring to feel like a strategy. It is the most powerful strategy most people will ever have access to, and most people do not fully commit to it because it does not feel like enough. It is enough. Private equity. The market nobody can see. You invest in public companies. Companies whose shares trade on exchanges. Companies whose prices you can check on your phone. The billionaire also invests in private companies. Companies that are not listed on any exchange. Companies whose value is not publicly quoted. Companies that most people have never heard of because they have no reason to be heard of yet. This is called private equity, and it is one of the most significant wealth-building tools in existence, and one of the least accessible to ordinary investors. Private equity works like this. A private equity firm raises money from large investors, pension funds, endowments, wealthy individuals, family offices. The firm uses that money to acquire companies, either privately held businesses or public companies taken private. The firm then restructures, improves, or grows those companies over a period of typically 3 to 7 years. Then they sell, either to another firm, to a strategic acquirer, or through an IPO. The returns on private equity have historically outperformed public markets over long time horizons. The Cambridge Associates Index of Private Equity Returns has averaged approximately 14% annually over the past 25 years, compared to approximately 9% for the S&P 500. The reason ordinary investors cannot access this is simple. Private equity funds typically require minimum investments of $5 to $10 million per investor. The SEC restricts private investments to accredited investors, individuals with net worth above $1 million, excluding their primary residence or annual income above $200,000. The return premium exists in part because of the illiquidity premium. Investors cannot sell their position for years. And in part because private markets have less competition, less information efficiency, and more opportunity for operational improvement than heavily analyzed public markets. The billionaire does not just invest in private equity funds. The billionaire often is the private equity fund. At sufficient scale, the billionaire acquires companies directly, restructures them personally, and captures the entire return rather than paying management fees to an intermediary. This is a category of investment that most people will never fully access. But understanding it explains why billionaire wealth compounds so much faster than ordinary investment portfolios. Venture capital. Betting on the future. Before it exists, the billionaire does not just invest in what is. The billionaire invests in what might be. Venture capital is the practice of investing in early-stage companies, startups, in exchange for equity. The companies have almost no revenue, sometimes no product, sometimes just an idea and a founding team. Most of them fail, completely. The money invested returns nothing, but the ones that succeed return not 2 times the investment, not 10 times, sometimes 1,000 times. Peter Thiel invested $500,000 in Facebook in 2004 as its first outside investor. He received approximately 10% of the company. When Facebook IPO'd in 2012, his stake was worth approximately $1 billion, a 2,000 times return in 8 years. Sequoia Capital invested $60,000 in Google in 1999. That investment is now worth billions. The venture capital model depends on a fundamental mathematical reality called power law returns. In a portfolio of 10 startup investments, 9 may return nothing. But one may return so much that it covers all the losses and delivers extraordinary overall returns. The billionaire understands power law thinking. Most people are trained in linear thinking. More effort equals more return. More risk equals more reward in proportion. Power law thinking is different. A small number of outcomes account for the vast majority of returns. The goal is not to be right most of the time. The goal is to be extraordinarily right a small number of times. This is why billionaires are not afraid of failure in their investment portfolios the way ordinary investors are. The billionaire can afford 9 total losses if the 10th is a Google or a Facebook. The ordinary investor cannot afford 9 total losses, which is why the ordinary investor should not invest in venture capital. But understanding the power law, understanding that concentration of outsized outcomes is the mechanism by which extraordinary returns are generated, changes how you think about your own career, your own projects, and your own allocation of time. You are also a portfolio. Your time is also subject to power law returns. Real estate, the asset class that never sleeps. You probably know about real estate investing. Everyone knows about real estate investing. What you may not know is the scale at which billionaires use it and the specific structures that make it so powerful at that scale. At the basic level, real estate investing means buying properties that generate rental income. You buy a house or an apartment or a commercial building. Tenants pay rent. The rent exceeds the mortgage and operating costs. The surplus is income. The property appreciates over time. Both the income and the appreciation build wealth. The billionaire does this at a scale that creates entirely different dynamics. A billionaire does not buy one apartment building. A billionaire funds a real estate private equity firm that acquires $2 billion worth of commercial real estate across multiple markets. The scale creates negotiating power on acquisition prices, on financing terms, on insurance costs, on property management fees. The tax advantages of real estate at scale are significant. Depreciation, the theoretical decrease in building value over time, can be used to offset rental income on paper even when the building is actually appreciating. Cost segregation studies allow certain components of a building to be depreciated much faster than the standard schedule, generating enormous paper losses in the early years of ownership that shelter real income from taxation. 1,031 exchanges allow an investor to sell a property and roll the proceeds into a new property without triggering capital gains tax. Indefinitely. The gain deferred through a lifetime of 1,031 exchanges can pass to heirs with a stepped-up basis, eliminating the accumulated capital gains entirely. The billionaire builds a real estate portfolio that generates substantial cash income, appreciates significantly, and pays minimal tax through legal structures that have been embedded in the tax code for decades. This is not magic. This is engineering. And the basic version of it, one rental property with a mortgage, depreciation deductions, and long-term appreciation, is available to anyone with sufficient credit and a down payment. The scale is different. The tools are the same. Hedge funds. The strategies. Most people cannot access. You invest long. You buy things and hold them hoping they go up. The hedge fund can invest in almost any direction. Long, short, market neutral, global macro, quantitative, arbitrage, distressed debt. Strategies that generate returns regardless of whether markets are going up or down. You cannot short sell easily. You cannot access leverage at institutional rates. You cannot participate in complex derivative strategies. You cannot invest across global macro positions that span currencies, commodities, and interest rate markets simultaneously. The hedge fund can do all of this. Hedge funds are pools of capital managed by professional investors using sophisticated strategies unavailable or inaccessible to ordinary investors. The minimum investment is typically $1 million or more. The fee structure is typically 2% annual management fee plus 20% of profits. The famous 2 and 20. The billionaire does not just invest in hedge funds. The billionaire is often one of the largest investors in multiple hedge funds simultaneously. With the negotiating leverage to reduce fees, access co-investment opportunities, and receive preferential terms unavailable to smaller investors. At the extreme end, Renaissance Technologies, the most successful hedge fund in history. The returns have been so extraordinary that the fund has been closed to outside investors entirely for decades. The Medallion Fund, available only to current and former employees of Renaissance, has averaged approximately 66% annual returns before fees since 1988, 66% per year. Compounded. The existence of this fund is publicly known. The strategies are not. The access is not available. It exists as a demonstration of what is possible at the intersection of extraordinary quantitative talent and sufficient capital to deploy complex strategies at scale. You cannot invest in Renaissance technologies. But understanding that these strategies exist and understanding why they are inaccessible is part of understanding the full architecture of how capital compounds at the highest levels. Alternative assets. The investments that look like collecting. The billionaire invests in things that do not look like investments. Art, wine, classic cars, rare whiskey, farmland, timberland, diamonds, watches, sports memorabilia, intellectual property, music royalties, film rights. These are called alternative assets. And at the billionaire level, they are not hobbies. They are portfolio allocations. A Basquiat painting purchased in 2010 for $8 million sold in 2017 for $110.5 million. A case of 1945 Romanée Conti purchased in the 1990s for approximately $100,000 sold at auction in 2018 for $558,000 per bottle. A 1962 Ferrari 250 GTO purchased in 1978 for $18,000 sold in 2018 for $48.4 million. The characteristics of alternative assets that make them attractive to billionaires are specific. They are uncorrelated with stock markets. When stocks crash, a Picasso does not necessarily lose value. This makes alternatives a genuine hedge against financial system volatility. They are scarce by definition. There is a finite number of 1962 Ferrari GTOs, a finite number of first edition Shakespeare folios, a finite number of bottles of Romanée Conti from any given vintage. Scarcity combined with growing global wealth means the pool of potential buyers expands while the supply does not. They generate social capital alongside financial capital. A Basquiat on the wall of your office communicates something that a portfolio of index funds does not. The alternative asset is simultaneously an investment and a signal. The billionaire treats these as a small percentage of a large portfolio, typically 5 to 10% of total assets. The allocation is large enough in absolute terms to matter, but small enough as a percentage to not be catastrophic if the market for a particular asset class shifts. The ordinary investor should not try to replicate this. The transaction costs, authentication risks, storage costs, and illiquidity make alternatives inefficient at small scale. But understanding why the billionaire holds them illuminates something important about wealth at scale. The billionaire is not just building financial returns. The billionaire is building a portfolio that survives everything. Stock market crashes, currency crises, geopolitical upheaval, systemic financial failures. Diversification at the billionaire level is not about spreading across stocks and bonds. It is about spreading across every asset class that has ever preserved value through every kind of crisis in human history. Their own companies. The investment with no ceiling. Everything discussed so far, stocks, private equity, venture capital, real estate, hedge funds, alternatives, represents the billionaire investing in other people's businesses and other people's ideas. The single most powerful investment the billionaire ever made was investing in themselves, in their own company, in their own idea, in the business they built from a garage or a dorm room or a couch in a California office. Elon Musk's net worth is not primarily derived from his stock portfolio. It is derived from his equity in Tesla and SpaceX. Companies he founded. Companies he built. Companies where his ownership stake, undiluted over years of building, is worth hundreds of billions of dollars. The return on equity in a company you founded and built from nothing has no theoretical ceiling. The venture capital investor who put money into Google at the seed round made extraordinary returns. Larry Page and Sergey Brin, who retained significant equity stakes through the IPO and beyond, made incomparably more. The founder's equity, the ownership stake retained by the person who created the company, is the single most powerful wealth-building instrument in the history of capitalism. It is also the one that requires the most of the person who holds it. Not money. Time, energy, judgment, risk tolerance. The willingness to build something that does not exist yet and hold it through every crisis and setback and near-death experience that every company of significance has faced. Most people will never build a company that creates extraordinary equity value. Not because they lack the ability, because they never try, because the risk felt too large, because the path felt too uncertain, because the job felt safer. But every person reading this has something worth building. Not necessarily a billion-dollar company, but something. A business that generates income. A skill that compounds into something sellable. A system that earns without requiring every hour you have. The billionaire's most powerful investment was not the one in someone else's company. It was the one in their own. Philanthropy as investment. The legacy portfolio. The final method is the one most people dismiss as not being an investment at all. Philanthropy. The billionaire does not separate giving from investing at the level of a foundation. The Bill and Melinda Gates Foundation has committed over $60 billion to global health, education, and poverty reduction since its founding. It has contributed to the near eradication of polio globally. It has funded malaria vaccine research that is saving hundreds of thousands of lives annually. The return on that capital is not financial, but it is real. It is measurable. Lives saved. Diseases eliminated. Educational systems reformed. Infrastructure built. The foundation is the instrument through which the billionaire invests in the longest time horizon possible. Not quarters, not decades, generations. Warren Buffett has pledged to give away 99% of his wealth, the majority to the Gates Foundation. Not because he cannot find better financial uses for it, because he has decided that at a certain scale, the highest return on capital is the return measured in human well-being rather than financial yield. This is not available to most people at the scale the billionaire operates. But the principle, investing in things whose return cannot be measured in dollars, is available to anyone. Your time invested in a child's education. Your expertise shared with someone who cannot afford what you know. Your energy directed toward a community problem that nobody is paying you to solve. These are investments, not financial ones, but real ones. The billionaire eventually discovers that the portfolio with the most durable returns is not the one managed by the family office. It is the one measured in the lives it touched. You invest money the way you were taught. The index fund, the 401k, the savings account you will move eventually. You're not wrong. You're doing the right thing with the instruments you were given. But now you know the full architecture. Public equities, available to everyone, underused by almost everyone. Private equity, available to the wealthy, inaccessible to most, understood by few. Venture capital, power law returns for those who can absorb power law losses. Real estate, the same tools at every scale, generating income and building equity while you sleep. Hedge funds, strategies invisible to ordinary investors, returns incomprehensible to ordinary math. Alternative assets, a portfolio that survives everything, built from objects that hold value through every kind of crisis. Your own company, the investment with no ceiling and the highest personal cost. and philanthropy. The portfolio whose returns cannot be measured in dollars but outlast everything else. You cannot access all of this. Not today. Not yet. But you can understand it. And understanding changes what you build toward. Understanding changes which doors you walk through when they open. Understanding changes the questions you ask and the decisions you make, and the things you spend your hours building. The billionaire did not start with the hedge fund. The billionaire started with the same index fund you have, and built from there, one instrument at a time, one decision at a time, one compounding year at a time. The architecture exists. Now you know what it looks like.